Hello and welcome to the Money Show, your one-stop destination for your personal finance queries. I am Kavita Thapliyal and we have lined up a power-packed show, and here's what you should expect on the show today. First up, we will discuss and analyze the possible consequences of missing an EMI and how you as a borrower can deal with such a situation. We will be joined by Aparna Ramachandra, founder director, rectifycredit.com. Next, we will decode how fluctuations in the currency market impacts your portfolio and financial goals. We will be joined by Tarun Birani, founder and CEO, TBNG Capital Advisors. And finally, on our last leg, we'll throw upon the counter to get your portfolio strategies checked by Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. So do send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on the Money Show at etnow.tv. So that's a lineup for the day. But then before we begin, let's get you the top headlines of the hour. Nifty gains more than 0.5% to settle above 17,700. Bank index at a month's high, but IT is the top sectoral loser. After SkyMed sounded alert, the IMD says it sees normal monsoon this year, expects the adverse impact of El Nino to be neutralized. In the latest edition of CEO at Work, Axis Bank, Amitabh Chaudhary exudes confidence about gaining market share across categories, expects credit growth to remain intact in 13-14% range along with steady margins, but deposit growth needs to catch up. Tamil Nadu bans online gambling. The law also seeks to regulate online gaming, including fantasy sports, which may now need vetting by multi-member committee. Good day for cryptos ahead of key US macro data. Bitcoin tops the $30,000 mark to hit a 10-month high. Ripple effect on Ether nearing $2,000 levels. All right, so let's begin the show. Despite your best efforts, unforeseen circumstances such as a job loss or a medical emergency may cause you to miss your EMI payments. Now, this often comes at a huge cost to the borrower, from impacting the credit score to levying penalties. Sometimes borrowers can even face harassment from recovery agents. On the Money Show today, we will discuss about these consequences and what you can do as a borrower to deal with such a situation. Let's bring on board Aparna Ramachandra, founder director, rectifycredit.com. Aparna, good evening and welcome to the show. So, time and again, we've picked up this topic. We've had a lot of discussion, but then this time is very crucial because we can see the burden of EMI building up on loan borrowers. So, although there can be a lot of reasons why a person can miss an EMI, and a lot of us know how important it is to pay your EMI. Not many of them usually land up missing it also. You will be having the best data on that though. But tell me something. Let's start by discussing the burden of EMI that has gone up. You talk about personal loans or you talk about home loan, car loan. Generally, what's the percentage of this loan EMI burden that has gone up?
Good evening, Kavita. It depends now, bank to bank from where they have borrowed. But tier one bank, there is a marked increase in the, unsecured loans that people have borrowed, especially the personal loans. And home loan, I mean, there is enough data out there as to how much, the increase has been. But we are talking about anywhere between, 3,000 to 5,000 rupees for every 50 lakhs that people have borrowed, so something like that. But more than that, what is little now worrisome is people have taken loans when they thought that the rates were continuously sliding down, but we've had situations where the rates have been going up steadily, and not everybody is in a situation where they can get a increase in the tenure. So if the increase in the tenure is not happening, then obviously the EMI is going to go up. So it is those profiles that one is a little concerned about. Of chances of missing this EMI is where is a little high.
Right. So let's discuss the reason why a person would actually miss an EMI. I mean, obviously, the place where you can't afford to make the payment could be one of the reasons. But a lot of time, people forget, or the reckless kind of behavior that we've been discussing earlier. So a lot of time, what happens is people think, "Oh my God, it's such a small amount. We can just pay it next month," owing to the kind of expenses they already have built up for themselves this particular month. But then the known facts or the dangers of missing an EMI, that will impact your credit score. But apart from that, there could be penalties, there could be legal action also. Let's discuss about that. We'll take it one by one. The immediate impact that one will see if one misses an EMI, and what kind of EMI will have what kind of impact, Aparna?
See, if you are missing an EMI, say for example, I will break this down into two things. If you've missed your EMI, as in you've not paid on your due date, but you've delayed it by say 10 days, 15 days. So on that day, on your due date, you missed your EMI, yes, but you've managed to pay between 10 and 15 days, you're still all right. You're not going to be penalized for that, because most of them today are a little lenient, and people are, I mean, lenders are okay with that. But then if you have missed an entire cycle, that means you have missed 1 month's EMI, is what we are, I mean, I'm assuming that's what we are talking now. So what happens is immediately two things happen. In the next month, suppose your EMI for this month was 10,000 rupees. So if you missed this, you are going to be paying this 10,000 plus the next month's 10,000, which is 20,000 already. Plus, you are going to pay some kind of a penalty for having missed out on this. So, which is anywhere between, it depends again on what kind of loans you've taken. So, if you are able to salvage by next month, you are still all right. But if you are not able to salvage, and this missing continues and spills over to the third or the fourth month, is where the downward spiral starts, because this starts to balloon. And then where you are not in a position to pay month one, then obviously you are nowhere in a situation where by month four you are going to be paying all of this, unless you are going to liquidate some asset, or do something else. So missing an EMI, the immediate effect is there are going to be penalties, there are going to be charges, and if there is already, like a direct debit that is set on your loan
So,
account,
Aparna,
then
when
there
we
is
talk about penalty or charges, what exactly is the figure and how is it decided, and how much penalty you'll have to pay on your EMI amount?
See, personal loans, obviously the penalty charges are higher.
Mhm.
Uh, but then when it comes to home loan, there is always there are three charges there. There is one a penalty, which is, that's what I was coming to. There is something called as a check bouncing charge, or bounce charge, because the lender has come to hit your account and there is no money there. So they charge you something like 750 rupees or 850 rupees, irrespective of the loan amount. So that is one charge. Then the second charge is anywhere between 0.25 to 0.75% of the loan outstanding. That's the second charge. And the third charge that is there is usually a late payment fee. So which is again something like 1,000 to 1,350, that in that range. That's the charge. So all in all, you are talking about another 7 to 8,000 rupees of excess, outflow if you've missed one EMI.
Let's talk about accumulated interest, because you just mentioned that in this particular answer also. If you miss an EMI, how do you accumulate interest, and then what's the severe impact of it on your EMI amount?
See, on a home loan, you are still in a better shape, because 2, 3 months, 4 months, the borrower, the lender is a little okay if you go back and say, listen, boss, like I always tell, I'm in a soup and, sort me out and rework my EMI and those kinds are still all right because the ticket size is usually bigger and the lender also doesn't want an NPA as far as the home loan is concerned. Now, where this is like a big dent on your credit score, on your credit profile, and everything is if you are defaulting on your personal loan and you are continuously missing your credit card payments. Now, credit card payment obviously is not an EMI, but that's your credit card bill. So, if you are continuously missing on this, then that is really going to impact you very highly. And then, like we all know, the credit card outstanding, it can be anywhere between 2 to 3% per month, which is compounded. So, it only multiplies from there.
All right. You also spoke about legal action that could be taken. Now, after missing how many EMIs do you get a legal notice?
See, normally, this process is a little longer. I mean, it doesn't happen overnight. So typically, 30 days, 60 day, 90 day, those are the buckets where the banks, usually are doing the collection calls themselves because your account has still not become an NPA. It is only when it crosses that 90-day is where your account is classified as an NPA, and then it depends, it either goes to a collection agent's bucket or so there is a good long journey there. So first is they try to recover, then they try to kind of how do I say, arm twist you or force you to pay. Then there is collection agents that do the call. By then they figure out, so by this time there is a good 5 6 months of this missing of payments, EMIs that is happening, credit card bills or loans that we are talking about. And then is where they try and come back to offer a settlement to you, where you don't have to pay the whole amount, but you kind of settle. So, and then there is a cycle, then there is a return of cycle, and it is much later that the lender decides to file a suit against you for not paying. So there is a long gestation period between you starting to default to you facing the legal action. Kavita.
Which also includes your property being seized?
Yes. So that the lender gives you enough chance to kind of see how he can salvage the situation for you before they get into the auction story. So today the NPAs that we are seeing, the asset reconstruction companies that are buying portfolios that we are seeing, there is a lot of water that has flown down before which this whole auction and recovery and all of that starts. Because please, remember, even for the lender, this is an additional expense. A, they have already made a loss on their loan that they have lent. B, they have to further incur expense to get this, asset auction. So they try and see how much they can support you so that you get back on track and pay them back.
What category of retail loans are there maximum NPAs reported so far? Any data on that?
Personal loans,
Personal
personal loans.
loans.
And I like I always tell you on this show, that is my biggest fear, because today all these online lending, these buy now pay later, then these holiday loans, biryani loans, and all of those are in reality personal loans. They may be giving you whatever flavor, whatever name, but fact of the matter is this is all personal loan. So the kind of personal loans that are being defaulted upon, that percentage is continuously on the rise.
Let's talk about missing EMI's impact on your credit score. Now, that's a question I had really kept for the end part of our discussion, because this is going to be a longer question answer round on this. So, first of all, how many EMIs do you miss and then it reflects on your credit score? Is just missing one EMI, irrespective of the kind of loan you've taken, but the fact that you have missed a repayment, this will definitely reflect on your credit score. But then after how many of them? Is it just once you miss and it will impact your credit score?
See, the whole credit score or your credit profile is a very cyclical thing, right? So if you miss, like I said, you make the payment in, a delay of 5 days, 10 days, nobody reports you and you get away with it. I mean, this is a reality. But if you default by 30 days, so you miss 1 month, you're already reported. So in your entire credit profile history, I mean, your credit history, this 30-day delay is always going to be reflecting, saying that this person had taken this loan and they have, defaulted by 30 days. So anything 30 days and above is going to cost you dear.
All right. But then let's talk about severe impact on your credit score and the way you can rectify it. So, obviously, one way to do it is just making your payments on the normal timeline. And if your credit score has really gone very bad, then maybe you need to figure out and, approach people like you who can help them rectify that. But then, what is that stage? When do you actually go out and seek help to rectify your credit score?
I would like to use this platform to reach out to people so that they don't get conned by these other people who are trying to pull up a fast one. When there is a delayed payment track record in a credit report, that never ever gets erased. So if somebody is going to tell you that you pay me 50,000 rupees and I'm going to clear all your old bad track record, it doesn't work. The person is trying to con you. So please remember, if you ever continue to miss your EMIs, it is going to be part of your history till the time that you are going to be looking for loans or cards, or somebody is just going to check your credit report. Maybe your employer, maybe your owner, if you are going to be renting out a property. So this part is always given. Now, when a person only is making late payments, now there are two situations, Kavita. There are some people on a regular basis because they don't get paid on time, or they are self-employed, so cash flow situations are there. They are not defaulters, but they are late payment people. So overall in the loan there is no default, they have not missed any payment, but they have continuously consistently made late payments. These are one category people. The second category people are, these are people who have defaulted and obviously there is late payment. Now this is where there is room for improvement, there is room for rectification, and a lot of things can be worked around and made sure that this profile is set right. So both the situations, if we will have to take a look, understand where the person is coming from, why the issue, and then go and represent him rightly to the lender and sort this case out.
All right, so consequences we discussed, which can arise if you missed an EMI, but then that's something alarming. You mentioned about personal loans. Last question to you: what tips would you want to give a person when they are thinking of taking a personal loan? I mean, obviously, it's a strict no-no, but if that's the last thing, a last resort that you really have to go, and there's nothing else that can be tried, what will be your tips?
Point number one, however desperate you are, if somebody is offering you a loan which is 24%, 28%, please don't sign up. It's okay. I don't know what your scene is, but then you know that you are going to be with, getting into a pit with your eyes open, because it is very, very difficult to sustain this kind of a repayment. Unless you know that, a month or two and something you're going to do and, sell off something, or get rid of some outflows and your cash flow improves, and you're going to be doing a transfer of this personal loan. But at the same time, please remember, a foreclosure of a personal loan, again there is a penalty. So if it is 24%, 28%, please don't get into those loans. Number one. Number two, personal loan is always a very shorter duration loan. So you know that you'll have to repay this between typically 2 to 5 years. આજકાલ it's very difficult. So somewhere between 2 to 4 years is where you know that you need to repay this loan. So please make sure that don't be under this falsehood that, agle saal I'm for sure going to get a 10% salary hike, or, I'm going to get an X amount of, bonus, and that's where I'm going to prepay. And so be very realistic at the current scenario, given your current income and your expenses plus the contingencies. See if you can sustain the loan, only then take the loan. Otherwise, please don't take the loan. Of course, if you have already signed up for a personal loan, and now that you are watching this, then you have two things to do. Please see if there is any way you can reduce your cash flows so that you don't falter on this EMI. Two, if that is not possible, see if there are any other avenues wherein you can, make some extra buck, or if there are those, dud insurance policies, or sometimes there are insurance policies against which, something can be borrowed. So at least those will be cheaper than this 24 to 28%. So do that math and then make sure that you repay this personal loan on time. Please do not falter on your personal loan EMIs. And the third thing, I was wanting to talk about it today in your show. A lot of people have this credit card dues, which is like a big chunk. Then the credit card company gives you an option where it says, can we convert this into an EMI for you? So this again is nothing but a personal loan that you are going to be paying for 6 months, 9 months, whatever. There again, because it is a credit card due that has been converted into a personal loan, the rate of interest obviously is higher. So if you can stretch yourself and repay this earlier, then don't unnecessarily sign up for 9%, 9 months and 12 months. See if you can stretch yourself and repay this in 6 months and get your act together. So that is again another personal loan, which is a very, very bad personal loan. So go for it only when you know your credit card bill is like hitting the roof, and there is no way you're going to be able to repay that in a month or two.
Exactly. So, working on
Yeah.
your repayment strategy is as crucial as figuring out the best interest on your loan that you might want to apply for. Thank you so much, Aparna, for being on the show and helping our viewers with this today. But then, time for a quick break. And after that, let's talk about currency and its impact on your financial goals and your financial portfolio. Back. You're watching The Money Show with me, Kavita Thagliyal. So, changes in currency exchange rates can impact the portfolio of investors in a big way. Fluctuations in currency exchange rates depend on several factors such as inflation, interest rates, geopolitical stability, the balance of trade, among others. Factors like these determine the health of your investments, and thus it is important to understand how these changes may impact your investments and your financial goals, especially if it's aligned with that. So, let's understand all of this. Let's welcome on board Tarun Birani, founder, CEO, TBNG Capital Advisors, and take this discussion forward. Tarun, good evening. Welcome to the show. Let's start by analyzing the currency play that you might not know your portfolio might have. So, whether you are diversified internationally or not, how does a currency movement impact your portfolio and the investment instruments that you are into?
Yeah. Good evening, Kavita. And currency definitely plays extremely important role on your portfolio as well as on your financial plan. So let me quickly try to simplify this beat. Right, last 1 year we have seen almost 8% fall in rupee, and we have seen variety of factors like surge in crude oil prices, lot of inflationary concerns, US dollar strength, as well as global economic uncertainties, which are not helping things, making it further. But at the same time, we have seen rupee has been one of the best performing currency compared to other emerging market. If we look at now, if I to set this context, I would like to mention that a portfolio has many impacts because portfolio has a lot of dollar defensive as well as dollar aggressive stock. To talk about dollar defensive stocks, we have stocks like IT, pharma, which definitely get benefited due to any fall in rupee. At the same time, there are dollar aggressive stocks which negatively get impacted because of, let's say, higher cost of borrowing and all those things. Apart from that, any rise in crude prices affects 80% of the landed cost. Landed cost of crude becomes higher. And just to give you a figure, 80% of the oil is imported in India. A lot of industries like paint, chemical, a lot of industries are impacted due to crude prices, and you can see hit on their margins. And that definitely, all these companies are part of your portfolio, so it negatively impacts. Again, I have seen these dollar, if defensive as well as aggressive portfolios are almost 50 to 60% of your portfolio. So it definitely impacts, and what your fund manager is picking up is going to impact your long-term returns. Again, one more important part in your financial plan is gold as well as global fund. If I look at gold prices are again negatively correlated with dollars. So any changes in dollar is going to impact gold. And I have seen gold is very large part of Indian investors' portfolio. So that will definitely have a very large impact. If I look at global funds, these global funds, from a structure point of view, they collect money in India and they invest overseas. So any fall in rupee impacts the prices. Again, these investments has been done keeping in mind global diversification, which is again a very positive thing. But end of the day, the change in the prices and fluctuation is going to impact the portfolio. One more very important asset class, which is debt, fixed income, is again going to get impacted. RBI moves at the time whenever you see there is a risk of environment building up in the globe, right? What we have seen, the dollar rising, right? At that point of time, normally central banks, RBIs, increase the interest rate at that point of time. And due to increase in the interest rate, you could see your debt portfolio, which is large in duration, which can get negatively impacted. And most of the time, people start building up more short-term and low duration portfolios. So all these definitely impact your financial plan. And one of the most important part of your financial plan and portfolio is assumption of inflation. So any changes in inflation, and since you are importing a lot of inflation whenever the currency depreciates, at that point of time, your overall projections got completely tossed, right? And for that, either you will have to take a very high risk or you have to invest much more amount to reach your financial goals.
So these points are very important for an investor to understand when it comes to your portfolio construction. But then going ahead, how can one analyze the rupee's impact on their portfolio? The kind of movement you've explained, inflation and other triggers. Although it's always very good to hire a professional, have a financial planner, or once you've given your money to a fund manager, he takes care of all of this. But then in your current juncture, if I want to understand, one wants to track the impact of currency on their portfolio, how can you do it, especially if it is lined up with your long-term goals?
I think the most important part is you have to make your assumption on inflation. Say 4 years back, your assumption on inflation was much lower when the rupee was much more stable, or at that time when the current or the interest rates were much more stable. At this environment, the inflation assumption has completely changed. So one of the most important point investor need to keep it in mind for their long-term goals, the inflation assumption. And I think one need to keep a good amount of margin of safety for this inflation figure, because any change in this can negatively impact your long-term projections. So that is one of the very important part. Second important part is retirement planning. I think a lot of people are doing their retirement planning, and one of the most important assumption there is their investment will generate X amount of return, then they will achieve this kind of return. For fixed income, which are like EPF figures, PPF figure, there you are relatively more confident and predictable returns are there. But investment which are very dynamic, let's say even if you look at debt investment, fixed income, duration investment, there your investment returns will change with the change in currency, change in inflation. At the same time, asset classes like equity again behaves very differently with inflation coming on board. So that will also change your investment returns. So it's very important for investors to be very dynamic about it and make sure their portfolio is completely aligned to their long-term goals. I'll give you a again, very important example. We have seen a lot of kids are going abroad, right, for their education. So their education planning again will their plans will
Just actually
completely
coming
change.
on
Let's say,
this, I was actually coming
yeah,
on this because what's happening is people, especially who've lined up their goals where they want to send their kids abroad for higher education, or could be anything, maybe an international trip as well. So, how would you analyze the impact for these goals? Also, now since we're talking about currency play, how can you strategize your portfolio to make the most of this current situation in terms of having an international exposure and that impact? So, two questions.
right. So first, I'll come to the education
Yeah.
planning bit. In terms of education planning, we have seen with the rise in dollar appreciating. That is actually, if you have a India only portfolio, it is negative for you. But if you have a global portfolio, that is extremely beneficial for you. If you have assets in dollars, that is actually going to benefit. And we are seeing large the inflation assumption on the education goal. Let's say my kid is 8 years and I'm targeting for his education at age 18. Normally we advise that always consider a 10% or 12% inflation for this, because 4 to 5% would be rupee depreciation, as well as 5% would be on the inflation front due to rise in the education cost. So when you put both of them together and start planning for it, you will make more realistic assumption about the projected amount which you need to work for the your kids education. Otherwise, if you take based on current numbers, I think your plans can completely go for toss. Again, one very important item is travel, and we are seeing with the rise of 8-10% in last 1 year currency, you can see foreign travel has become extremely expensive. On top of it, now you have a TCS also, right? For any money you spend over going abroad and all, the foreign tour travelers will ask for almost this TCS amount, which again can be adjusted against your normal tax amount, but again it is going to hit your cash flows. So all these are not very positive factor for your travel plan. So my suggestion is, uh, you should do things which are in your control, and what we can control is looking at last 15-20 year track record. Rupee has been depreciating at 4 to 5%. So in your education goals for your kids, in your goals of your travel plans, always keep this inflation figures in mind, 8 to 10% rise. Once you keep this in your planning, I think you will work with a very more realistic projections, and you can start allocating your investments accordingly so that you can achieve your investment goal for that point. Yeah.
All right. In the end, now time to rebalance your portfolio, looking at all these triggers, or one should just let it be if you're into it for a long term. You really don't have to rebalance any particular asset class in your portfolio, looking at the currency weakness.
I think rebalancing should not be planned based on any currency movement. I think it is more of a strategic asset allocation plan for your portfolio. And again, it depends on many factors, right? But what is, according to me, is a good exercise is if based on your basic risk tolerance level as well as your risk profiling, you have identified that your equity portion should be X, let's say 70%, and your debt portion should be 30%. Now, with the change of definitely a change in currency will have impact a lot on the asset classes movement, debt, equity, and all. And you will see the prices of all these asset classes will change because of that. If you see your 70-30 equity is moving to say 60-40, you need to add more 10% to rebalance your portfolio, because equity is becoming more attractive and your portfolio wants more equity allocation. At the same time, if it becomes 80% equity, at that point of time, you need to sell some equity to rebalance it back.
Sure. I think that will be all. Thank you so much, Tarun, for being on the show and helping our viewers, helping them understand what's the impact of currency movement on their portfolio and investments. On that note, let's take a quick break. Post that, we'll be joined by Gautam Kalia, who will be answering your portfolio queries. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hi, good evening, Gautam. Welcome to the show. And we have our first viewer's question for you. Okay, so we have our Arunachalam from Coimbatore who wants to ask you a question, and he seems to be having loss in his Axis Blue Chip Fund. I think I have Mr. Arunachalam online also on the phone line with me. Good evening, sir. How are you doing?
Yes, there's only one question whether I have to hold this Axis Blue Chip or exit. It is giving loss for the past 1 year.
Got it, sir. So do you have any other blue chip in your portfolio, or that's the only fund?
Sir, I have one mutual fund, SBI small cap, and ICICI equity and debt fund, balance advantage funds.
All right. Gautam, let's understand the non-performance, because Axis Blue Chip has been on radar for a lot of investors where they are not happy with the performance of this fund. I mean, yes, the large cap story is not very upbeat right now, but even before this trajectory began with the large cap underperformance, this fund in particular has been in concern.
Right, Kavita. So, yes, a lot of clients were looking at this fund because this fund was doing extremely well about a year back. And a lot of allocation did come into this fund across clients because of the performance. And then obviously we are aware that there was front running through at the fund house, but that obviously is not really directly linked to the performance of this fund. It's just that most funds, when you invest in, you should give it some time, especially if it's in your portfolio, to deliver return. But you should wait for, let's say, your distributor advisor to kind of give you that call when they kind of give up on the fund and they suggest better options. And in such a competitive market, there are unfortunately always better options, fortunately or unfortunately. So our research is suggesting that we move the allocation from Axis Blue Chip Fund to ICICI Prudential Blue Chip Fund. That is a relatively more higher confident bet from our research side for allocation to the space.
All right. Is there any other question that you want to ask, Mr. Arunachalam?
Yeah, that's only question. I will hold till the market rates. Okay, market is raising, and I want to exit, not want to continue this. Okay.
Thank you so much for sending us your query. We move on, and Krishna Atheja's portfolio. Gautam, he has invested in Canara Banco's equity tax saver. He has Quant small cap. He has Nippon S&P index fund on him, and lump sum investment. He also has Axis Blue Chip, and lump sum investment is in Axis Growth Opportunity. He wants to understand if he can continue with the Axis funds. Clearly, the trigger is the AMC's underperformance and the various funds underperformance. Time horizon for this particular investment is 20 years, and if you suggest him to move out from a fund, he wants to understand where can he invest it and what should be the reinvestment strategy.
Right. So he's already got a SIP of 11,000 rupees per month, and a plan of for 20 years. Nippon S&P Index Fund, Quant Small Cap Fund, and Canara Robeco Equity Tax Saver. So he should continue those SIPs. He's made that lump sum investment in Axis Growth Opportunities Fund. So we're coming back to the question of Axis. Really, when you look at fund houses, and especially someone like me, I've interacted with fund houses over the last 20 years. each fund house or each fund manager, they have a particular style approach. They have a methodology for selecting stocks, and that methodology, when they select the stock, post that, it's not just about you, it's about the market aligning to your interest and moving with your interest. So that is something no one can control. So really, earlier when Axis was picking stocks, the market was also aligned to their stock picks and was moving in that direction, and that's why the returns were fantastic. Now the returns are slightly on the lower side, and that's why these questions are coming up. Again, my suggestion there would be that you can review and shift your existing allocation from Axis Growth to the large and mid cap scheme of Kotak, the Kotak Equity Opportunities Fund. So that is the only change that I can suggest, that Krishna can make.
One strategy I wanted to understand that a lot of investors have actually adopted, Gautam, which is having an SIP in one fund and doing lump sum investment also in that particular fund. How does it change your average buying cost and returns over the period?
Right. So if you're just doing an SIP, then it's fairly simple. But when you're adding lump sum, then what ends up happening is it's like a weighted SIP, and usually the lump sum amount is significantly larger than the SIP. And investors do that when they are fairly confident of a particular scheme. It's okay to do that because you don't want to end up with these schemes that just the right way to manage when you have multiple schemes. So I think if you believe in certain funds, you believe in a fund manager philosophy, you're getting that recommendation also from people you trust, then you should continue that way. Obviously, what ends up happening is that it becomes like a weighted allocation every time you make that lump sum investment because you're buying units at a so it's not pure SIP. So it should be viewed also like that with the knowledge when you're looking at its performance.
Got it. Gautam, we'll move on to our next viewer, which is Jayesh, and he wants to understand which is a better fund, SBI small cap or Nippon India small cap. We don't have him on the phone line, so we really don't know what's the current status or how diversified he is across market caps. But then talking about selecting a small cap, one really needs to know that you have to be invested for a longer period of time, which could be 5, 7 and plus years. And talking about performance, I want you to first tell us the performance of both of these funds and how can one align their goals and which fund is better as per the fund manager strategy.
Sorry, I don't have the performance readily available with me, but let me just give you the thought process. SBI mid cap is what our research is recommending, and I'll just explain the thought process that goes behind selecting one fund over another. So there's a qualitative set of parameters and a quantitative set of parameters. Quantitative obviously looks at past performance, and it's not just point to point, it's on a return basis. And they also look at things like the amount of risk taken to achieve that return. So some funds can take extremely high risk and deliver high return, but it's also about managing that risk, especially when the market corrects, then that risk comes to fruition and your returns become more negative. So that's what we call a drawdown. So the quantitative parameters are mostly focused on return and the risk, and the qualitative parameters actually can extend, and you can go up to 30, 40, 50 parameters there. But really, it's more about corporate governance, the investment process, whether you're relying on one individual or the whole host of individuals. Is there a support team or qualitative analysis team? Who's looking at the risk management? Is there someone outside the fund management team also tracking the risk management? So a combination of these factors will help you arrive at schemes that are more likely to give better outcomes. Not the best return, but at least the better than average risk-adjusted return. So that's really the gamut through which most research teams select schemes and then make a choice between one over the other.
We move on to our next viewer, Vivek's question, and he wants to invest for 20 years. Right now, he's doing SIP of 40,000 monthly. Kotak small cap, PGI mid cap, Parag Parikh flexi cap. He has PGIM Flexi Cap, Navi Nifty 50 Index, Navi Nifty Next 50, and Navi US Total Stock also. And he started investing in June 21. So, all right. How would you like to filter out his portfolio?
Yes, so he's got a SIP of 40,000 rupees per month, but the allocation to mid and small is roughly 50%, which is quite high. And that's why the suggestion is to kind of reduce that allocation there. So the 10,000 rupees per month that is going into PGI mid cap, maybe reduce that to 5,000 and move that 5,000 to a large cap scheme like ICICI Prudential Blue Chip Fund. So that way you are kind of rebalancing the allocation within equity space more defensively. And I think that nothing else, no other change required. I think in terms of the index funds that he has, otherwise Parak, Parik, PGM Flexi, yeah, everything else seems to be all right.
One thing I wanted to understand now, as compared to all the AMCs mentioned in this particular question, Navi is comparatively new. How can investors actually check the status of an AMC, which is as new as Navi, and a lot of them coming ahead also? How would you decide? Because that trust factor is important. You know, if you're already investing with an established brand, you know there is a safety comfort over there. But then talking about these new AMCs, what all do you need to see before picking up a fund from them?
Right. So, they're very, very important, and actually, it's a very tough question to answer. But really, whenever there are new AMCs, you have to do a AMC level due diligence, and that's what research teams do when it comes to asset management companies. And while I don't want to get into the details here of the depth required for AMC level due diligence, what an investor can do really is understand the regulatory framework within which AMCs operate and know that the regulatory framework is robust enough that their money is protected and their money is safe, right? Because that is the first consideration. Obviously, second is that it will not be managed well, but the first is that it is, the money is safe, and then we come to the second part, which is whether it's managed well. And if there are specific fund managers or you're betting on some active fund management, then obviously you need to look at the scheme performance and the fund manager history and investment process that are put in place. Otherwise, in this case that Vivek has invested, really the investments are in index funds and passive funds. So in passive funds, the risk of mismanagement is only to the extent of the fund not tracking the benchmark very closely. And if a fund is not tracking the benchmark very closely, it's probably one because the cost is slightly high, or the operational structure of the fund is such that it's not being able to rebalance the portfolio as frequently as the index is rebalancing itself. So if it's operational, then it can go either way. You can have one deviation from the index through a passive fund, and that deviation may work in your favor. But if it's on cost basis, then that is something to be considered seriously and maybe look at a cheaper index fund.
We move on to our next viewer's question. Naresh, she wants to know how to invest in a large cap, mid cap, multi cap, and flexi cap funds for long term.
Right. Again, this advice I give to most investors who come with a question like this, that please think of long term as a minimum 5-year investment horizon. And when I say 5-year, it is the investment horizon is in the asset class, which is equity, and not the schemes themselves. You should keep reviewing your investments in the specific schemes and seeing if there are better options available. But you should stay committed and invested in the asset class. So for Naresh, we created a portfolio. One is the ICICI Prudential Blue Chip Fund in the large cap category, the Mire Asset Mid Cap Fund for mid cap exposure, the Nippon India Multi Cap Fund for multi cap exposure, and the HDFC Flexi Cap Fund for flexi cap exposure. So depending on your preference, maybe you can do a 25% allocation to each of these funds to start off with. It obviously depends on your risk profile and other parameters. But if it's a 5-year plus horizon, then you're pretty okay going in a portfolio like this.
Gautam, now since Naresh wants a suggestion on large cap, mid cap, multi cap, and small cap, you get a complete exposure if you just pick up a category like a multi cap and a flexi cap. Despite of having these categories in a portfolio, do you need a concentrated large cap and a mid cap or small cap, or you think that exposure from multi cap and small cap across market caps categories is more than enough?
I think it's more than enough. It's not specifically required. It just what happens is the journey of the client becomes so performance attribution becomes a little bit tricky. So when you have a mid cap or a flexi cap, then trying to figure out whether the fund has done well or not and why, that becomes a little bit tougher in a multi-cap flexi cap. So when you have dedicated allocation to, let's say, a large, mid, and small, then it kind of becomes easier because the benchmarks are clearer, performance comparisons become much simpler to understand and track. But besides that, which is, I would say, a more operational reason and which is a more ongoing reason, I think it's just more convenient if you go in for a flexi cap because you're leaving that decision up to the fund manager. You're anyway leaving all decisions to the fund manager, except for the key ones, which is how much money you want to allocate and for how long, which are the most important decisions that the investor takes. So if you're anyway leaving the stock selection, what price you're buying at, what price you're selling at, you can also leave this decision on how much allocation you're making to large, mid, and small.
All right, I think that will be all for today, Gautam. Thank you so much for making time and helping our viewers with their financial portfolio. And before I sign off, I'm going to leave you with our WhatsApp number and email ID where you can reach out, you can send us your portfolio related queries, and we will get it sorted by our experts live on the channel. Thank you so much for watching. Goodbye.